Insurance companies are businesses that provide financial protection to individual and organization. When people buy insurance, they pay a regular fee called a premium. In return, the insurance company promises to pay for specific losses like damage to a car, medical expenses. There are different types of insurance, such as life, health, property, and vehicle insurance. The company help reduce the impact of unexpected event by sharing financial risks. They bring peace of mind of policyholder by offering the sense of security. Without insurance, unexpected events could lead to the financial hardship. Insurance companies play an important role in society. First, they help manage risk by protecting people and businesses from major financial losses. Second, they provide financial stability which support the overall economy. Third, they invest the money collected from premium in things like bond and stocks which help the economy growth. Finally, they create job opportunity in variety area such as claim underwriting and customer service. They are support innovation by giving businesses the confidence to take risk. In time of disaster or crisis, insurance help communities recover fast.
In this part of the video, I'll be explaining the structure and main activities of life insurance company. Let's dive right in. What is life insurance? Life insurance is a contract between a policyholder and insurance company. The company promises to pay a sum of money to a beneficiary upon the death of insured person or after a set period in exchange for regular premium payment. There are few main types of life insurance. Term life insurance provides coverage for a specific time, usually 10 to 30 years. Whole life insurance covers you for your entire life and include a cash value component. Universal life is more flexible, letting you adjust premium and coverage over time. For a real-world example, is like a AIA Malaysia offer term, whole, and investment-linked life insurance. Life insurance company generate revenue in two major ways. First, through the premium paid by policyholder, and second, by investing that money into assets like bonds, stock, or real estate. The goal is to grow funds to cover future payout and make a profit. For example, like Great Eastern invests heavily in government bond and real estate for steady long-term return. They also manage policies by underwriting, which means assessing risk before approving coverage. When a claim is made, they verify the detail and then pay out the death benefit or maturity value according to a contract. Last but not least, to stay financially stable, life insurance use risk management tool. They diversify investment, maintain reserve, and often purchase reinsurance, which means they transfer some of their risk to other insurance companies. Next, we look at how property casualty insurance companies operate. Over to speaker 3.
Hi everyone, now let's take a closer look at property casualty insurance companies, what they do, how they operate, and the risks they face. Property casualty insurers cover physical assets and liabilities. This includes auto insurance, homeowners insurance, commercial property and liability insurance, both personal and business related. Basically, they protect against unexpected losses and damages. Before offering coverage, insurers perform underwriting. They assess factors like your location, age, and past claims. Based on the risk level, they set a premium. Today, companies use big data and AI to improve pricing, accuracy, and reduce losses. These companies face major risks, such as natural disasters like floods and earthquakes, which can cause massive losses. Fraudulent claims and inflation also impact their profitability, and large-scale events like a pandemic or war can push them into crisis mode. When an incident happens, the policyholder reports the claim. The insurer investigates, assesses damage, and if everything checks out, pays the claim. Many insurers now use mobile apps to speed up this process, making it more convenient for customers. That wraps up the key operation and risk of property casualty insurance. Up next, let's explore how insurers respond during major financial crises.
Now, I will share a brief case about insurance during crisis, focusing on Lehman Brothers and John Schroeder cases. Lehman Brothers was one of the biggest investment banks in the US. When it filed for bankruptcy in 2008, it shocked the global financial system and triggered the economic crisis. that we now know as a global financial crisis. At the same time, John Schroeder, who worked at the Sidley Austin law firm, was found guilty of designing illegal tax shelter scheme for clients, including Lehman. This brought a legal and financial trouble, not just to Lehman, but also to Aruba personally. Now, let's look at how insurance was involved. Lehman top executives were covered by director and officer insurance, which is meant to protect a leader from a lawsuit. After the collapse, many lawsuits come in, but insurers limited or denied payout, claiming a fraud, exclusion, or arguing that Lehman bankruptcy complicated coverage. For Aruba, professional liability insurance may have helped cover legal fee at first, but since the charge involved intentional fraud, the insurer could refuse coverage or even claw back the legal costs if he was found guilty, which he was. This case revealed several insurance challenges during the crisis. Firstly, fraud allegation can make insurance invalid. Next, when a company goes bankrupt, many people fight over the same policy. And finally, policy wording matters like exclusion, timing, and claim periods. So what can we take away from this? First, insurance is crucial but has limits, especially in cases involving misconduct. Second, company must carefully check policy detail to understand what really covered. And third, even if legal costs are paid early on, they might be taken back if wrongdoing is proven.
Insurance companies are heavily regulated because they handle large amount of public money and long-term financial promises. In the United States, insurance regulation is primarily handled at the state level, thanks to the McCarran-Ferguson Act of 1945, which confirms states as the main authority. Each state has its own insurance commission, which oversees licensing, policy system, premiums, and insurer investment. To coordinate across states, the National Association of Insurance Commissioners, or NAIC, developed examination system and model regulation. After the 2008 financial crisis, however, federal oversight expanded. The Federal Insurance Office (FIO) was created to monitor systemic risks and international insurance issues. Alongside it, the Financial Stability Oversight Council, or FSOC, can label large insurers as systemically important if their failure could threaten the broader economy. Additionally, state guarantee funds act as a safety net, protecting policyholders when an insurer fails. Top coverage levels and payout speed can vary widely. The 2008 financial crisis and the Russian rubber collapse exposed real weaknesses in the insurance industry. In the US, companies like AIG were overexposed to risky investment and complex derivatives. When Lehman Brothers collapsed, AIG required a government bailout of over $180 billion to avoid complete failure. In Russia, the rubber crisis caused massive currency devaluation. For insurers, that meant investment losses and policy payout that were suddenly worth far less in real terms. Many people stopped paying premiums, further destabilizing the system. This crisis showed that insurers, both life and property casualty, are vulnerable to macroeconomic shocks, especially if their portfolio are not well diversified. They also emphasized the need for strong liquidity, capital reserve, and effective oversight. Lastly, insurance is built on trust. People pay premiums today for protection that might not be needed for years or decades. The trust only works if insurance companies stay financially stable even during global crises. Going forward, the industry must balance long-term risk protection with short-term market volatility. Regulation and smart investment policies are essential to keeping that balance. As we have seen from Lehman and the rubble, the next crisis may come from anywhere. The question is, will the insurance industry be ready? That's all from us. Thank you very much for your time.